Well, that was quite the rally. Kind of shows us not to really trust a lot of what happens overnight and in the mornings on lower volume in the futures market once real volume, market trading volume kicks in at the market open. So I'm going to dissect today's move, which is quite the rally that we had. Created a lot of interesting bullish patterns on the chart. So we're going to break those down to see whether or not this is the beginning of a new bullish trend or not, and what factors that might impact that. And we're going to take a look at, one sector, one kind of class of stocks that have really done well off of Monday's low point during this kind of 2+ day rally to try to find a trade idea. So let's go ahead and get started. Today is Wednesday, April the 4th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching us for the very first time. Glad you found this. Keep coming back, watching day after day. Subscribe to my YouTube channel by clicking that red subscribe button right down below the video there. You can do that right now while you're watching. Also, while you're down there, click the thumbs up icon. That lets me know that, number one, you like today's video, you got some value out of it. Number two, it tells me, go ahead and do it again tomorrow, David, right? It's one click way to give me feedback and tell me that you like the video. Comment on anything that stood out to you from today's video. You can do that further, scroll down further down below. And then finally, join our daily email, Market Scholars daily email list. You'll see a link in the description to be able to do that. Follow me on Twitter for more content in addition to these videos. You see my handle up on the screen, at DavidSettle42. Like and retweet tonight's Market Outlook tweet. Again, one way to tell me that you want me to keep doing these videos. Also, lets Twitter know you want them to keep pushing you all of my tweets, all the content that I put out there on Twitter. The benefit I get out of that is the more likes and retweets any one tweet has, the more Twitter will think they should push that out to all my followers that I have on my list. Finally, join our Market Outlook community. You see the address up at the top there in Facebook. There's also a link down below. Almost 1,000 of us that watch and discuss these videos, as well as stuff outside the videos. So come join us, our community. All right, well, let's start off taking a look at the S&P 500 here with the market forecast indicator, which you can see has turned bullish today. So as bearish as we've been over the last few weeks, today's candle about as bullish as you could be to an extent. We'll talk about that throughout the video today, but still pretty decent candle here that you can see now is broken above this downward trend line that I had drawn on this near-term drop that we've had. And so we've broken above that near-term drop, and the near-term line has broken up to into the upper half of the zone, so upper half of the chart for the first time in 14 days. So pretty decent move here, enough to get the posture. Now, again, it's bullish, but let me stress, it is about as weak a bullish posture as you can possibly have. So it's bullish with a huge asterisk, right? Because it's like your favorite NFL team has the ball on their 1 yard line. And it's not quite the half-yard line because it's the 21st percentile. We're not 20.33, we're at 21. So you're like on the 1 yard line right now. About as backed up against your own end zone as you could possibly be. Again, that would probably be the worst field position you could possibly have. So, to use that analogy there. So keep that in mind. While I do say we are bullish, I'm not like back up the trucks bullish. So I want to make sure everybody understands that. You can see that we've gotten back up to 2650, which had been a support level. That's the low point we got to in the beginning of March. We came down to it, busted through it, got back up above it. You can see we still haven't broken below that low point, even with today's crazy trading. That low point in this long lower shadow here are still acting as a support level. But the posture now, okay, so we'll see. Is this bullish posture going to turn around now and be the start of something special, right? Well, there's two things that we need to see to really feel good about the beginnings, really now three for that matter, that we need to see. Number one is the optional one, and that is the momentum line getting to an extreme high. So something like this over here, or something like these two over here, but to an extreme high that would be kind of that first sign that the trend is changing. And we didn't get that one here. You can see it because how wide these candles are and how big the ranges have been. You know, it's hard to get those at these low points like this, so we just don't have that. You usually get those when you have, you know, a weak posture that turns back around again, and you get bullish without the intermediate line getting too far to the downside. We don't have that without the VIX getting too high, which creates all these big candles like we've got. The second thing, which is not optional, is the near-term line getting in the reversal zone, getting in the upper reversal zone. When you're bullish, you can see every peak, and this goes for just about any technical indicator, any kind of oscillator, right? Especially one that looks at, you know, highs and lows and closes and all that. You want the peaks to get in the reversal zone during bullish moves, and you want the low points to not get in the lower reversal zone. So during this 5-month bullish trend, you can see just about all the peaks got in the reversal zone, and none of the lows got in the reversal zone until back here, and that's when the posture changed. Okay, so we need to see that, and that hasn't happened. You notice that 38% Fibonacci retracement on the long-term rally, the market sentiment rally, that has ended now that market sentiment's dropped below 50. So that's it. That's the rally. You know, we are potentially starting a new long-term move that we haven't had. You know, just to kind of give you an idea, this is how often these occur. So we've got 2 of them in 2016. Right, the one off of the lows in early 2016 that had a decent run for most of the year, and then the one right before the election that started the current multi-year rally that we've had. We had one at the end of 2015, and remember, both of those were significantly below the 200-day moving average, and we just sniffed below it today. Before that, we had a multiple-year rally without any significant long-term move, and that was fueled by QE3, right? The QE3 that started at the end of 2012, lasted throughout most of all of 2013, most of 2014 when it tapered there, and then we kind of were grinding to a halt in 2015 without anything helping, and that's where we got, you know, the breakout there. So, but you know, in 2011, we got the credit downgrade move that brought us below the 200-day moving average, brought us market sentiment down low. You got Operation Twist that got us into 2012 QE. And that's where QE3 was announced and started, right? So we have a couple of opportunities there with market sentiment below 50. 2010, right before QE2 started, we had a dip below 50. So, I mean, look, you know, how many years? 1, 2, 3, 4, 5, 6, 7, 8 years from 2010 to 2017. And we had 1, 2, 3, 4, 5, 6, 7 dips on the market sentiment line below the 50th percentile. So we don't get these kind of dips very often. In the last few, I mean, the one at the end of 2016 was much higher than we got compared to the previous one at the beginning of 2016. Those two, it was actually a lower low that we had there. And then in 2012, 2013, 2011, each successive low point was higher, and we went up to new higher highs every time too. Even 2010, you can even say that the one in 2011 was higher than the one in 2010. And again, higher high, higher low, higher high, higher low, higher. And I'm talking long-term highs and lows, not intermediate lines or blue lines. Long-term lines down here. Always higher highs, higher lows until that time. And now again, higher high, because we broke up just barely through in 2016. Higher low, much higher high, and potentially new higher low point. So, you know, using Fibonacci's to tell us where, you know, it will find some support. So, needless to say, this is opportunity we don't get very often for a long-term move. Now, you know, some of those long-term moves didn't last. I mean, we had a couple multiple years, but a couple of those were fueled. This current one was multi-year long-term run was fueled by, you know, Trump and fiscal policy anticipation expectations. The one before that, the 2013-2014 move, multiple year run, was fueled by QE3, this indefinite asset purchase program. So, you know, are we going to get a full year's worth here? You know, without anything, you know, tax policy, you know, related, or, you know, any kind of fiscal policy anticipation, which is what fueled a lot of this run here, especially the last part of the run, or any kind of monetary policy to help things out, then it might not last. It might not be a multiple year run. It might be more normal, kind of like, you know, 6 to 9 months kind of a thing. where we might get. So keep that in the back of your mind, which would last us through the rest of this year, which, again, we've talked about before, that when we've had this kind of a run, 5+% run in January to finish the quarter. First of all, the average return for any calendar year that started off that strong in January has been 24, 25%. And then the one time in history that you started off that strong and finished the quarter with a negative, finished with that average return too. The one time it finished with that average return. So that orange line represents that average return by the calendar year, by the end of the calendar year. So that's what the S&P 500 is looking like. So bullish posture, things are looking positive. Probably need to get above 2650. Need to get that near-term line. So I didn't finish the third thing. So the first thing was the momentum line. That's optional, spiking to an extreme high, the red line. The second thing is the blue line getting into the reversal zone. Hasn't happened yet. The third thing, which also definitely hasn't happened yet, is for the bulls to get across midfield. Or in other words, get up above the 50th percentile. The intermediate line, the green line, get up above the 50th percentile. Once you get that, then we're good. We feel much better about the beginnings of that 1 to 3 month rally, and we would expect closer to 3 months because the market sentiment line's lower than we saw back here. Now, here we got a 5 month rally, but that was fueled by tax policy anticipation at the beginning of the year and all that. The market sentiment line was a lot higher low point we were coming off of. So we were coming off a much lower low point. So our expectation, while it was over here more towards 1 to 2 months, we just happened to get 5 because of what was going on, strong trend, and the end of this big run, and kind of the last gasp kind of a thing. That doesn't change the fact that the expectations were only for a shorter time frame, and now the expectations would be for a longer time frame, longer for that average, that 1 to 3 month average, because we have more room for market sentiment to roll over, because it takes a while for it to roll up and then head up and head back up towards that upper reversal zone again, off of what would be a higher low point here at the 38% Fibonacci retracement compared to the last market sentiment low point we had in November 2016. And when you come up off of higher low points, the expectation is you would get up to higher high points. And when you combine that with this kind of that average run here, right there, that's where it's ending, right there. So that's the end of the year. Then that would obviously be a much higher high point. If we were to come off this higher low, and then we'd anticipate it to go up to that higher high. All right, so now let's take a look at the Dow Jones Industrial Average here, and you can see its near-term line did get in the reversal zone, but still only dipping its toe above the water. It hasn't quite gotten above these highs yet, so grain of salt there, but still a weak bullish posture with market sentiment line setting up for a decent low point, a decent launching point there. NASDAQ's got a really bullish candle today, encapsulating. First, you got that Harami yesterday with a long lower shadow. And then today, I mean, you can even kind of call that some kind of morning star candlestick pattern there after this attempted morning star candlestick pattern at the end of last week. This, you can kind of call this one. But the reality is long lower shadow, big bullish engulfing pattern, pretty dang good, pretty bullish candlestick, pretty decent bullish candlestick reversal pattern there. But not enough yet to get the blue line where it needs to be, and for that matter, to get the intermediate line out of that reversal zone either. And then finally, the Russell 2000, same thing. Its intermediate line has turned up. It's had a pretty decent bullish candle, closing above the high of the low day. That being the day with the lowest low point, we closed above that day's high. As bearish as that day was, Monday, we've closed up above its high point with these last couple of days, and that's turned that intermediate posture around.
Really quickly, I wanted to inject again, if you're watching this video on the Market Scholars blog here, embedded here in the video, remember you can discuss tonight's video in the forums with the link right above that. Just click on that link, create any new topic, or reply to anybody else's topic in that forum. Also remember to like and you can like the today's Market Outlook tweet here just by clicking that heart right there while you're watching. You can also do the same thing on Facebook. If you have a Facebook account, go ahead and click that thumbs up right here while you're watching. 2 really quick clicks. Of course, you can like the blog post as well and let me know there with this new feature we just added. And if you haven't signed up for the email, you can sign up right here at the bottom. Again, all while you're watching the video embedded above. And again, if you want to share this video on LinkedIn, on Twitter, or on Facebook, just click any one of those links and they will automatically create a post for you, then that you can just click and share and get the word out to people. All right, so the long-term chart you can see is, again, forming another long lower shadow potentially. Now, we've got the rest of the week, got 2 more days left, and if we go up from here, that still leaves the long lower shadow, which is bullish. But 2 days into the week, and you can see when you get the long lower shadows around that 50-day moving average, or the 200-day moving average, excuse me, we tend to get a good bounce off of that. So a pretty good bullish candle so far, right? 2 more days left, but so far, pretty decent bullish candle there on a long-term perspective. Then, of course, the 3 green arrows, you can see we're really close to getting 2, right? That MACD and the stochastic's not quite there yet, but the MACD, the stochastics has crossed above its moving average and has crossed above the 20th percentile, just not above the 25th, which is where you get the green arrow on that particular study set. You can see we did finally get above the 8-day moving average here. Still below the 17-day, but a positive sign getting above the 8-day like that. And the MACD also getting above, or close to getting above its moving average, which would give you a green arrow. And you remember, typically when you come off of these lows, these deeper lows on the MACD, we typically come up pretty sharply. We don't grind our way up. Usually we grind our way down. And then we grind our way up when we're coming up a really shallow dips in the MACD. This is a much deeper dip, and we usually come back up pretty quickly. So we'll see if we come back up towards that 30-day moving average rather fast if we can maintain this bullish sentiment that we've had today, or really over the last couple of days. You can see how bullish we've been. Again, the low point at the end of Monday kind of established. We had a decent day yesterday, and we, gapped down, of course, with the trade news, tariff news here early this morning, only to rally up to yesterday's high, ending day high, 261. Came off of it just a little bit, down to 260. There's some support in that area, and then bounced right through from 260 to 264 at the end of the day. Very strong push, getting up above that. We see there multiple resistance at that area, this downward sloping trend line on a near-term basis. Busting right on through that. Again, very volatile day in terms of trading range, about, 7 points there. Filled in the gap, so we've got that covered in the range. So almost 8-point range. But look at that volume. So the volume not really so extreme here the last couple of days after coming out. But you have to remember too, the volume on these down days were not nearly as extreme as they were on these low points that we had in February. So the market wasn't nearly as bearish as it seemed to be. It was more backing and filling, so to speak, into that trading range. That happens a lot. When you get those long lower shadows on a weekly basis, it happens. We tend to come off of those and then fill them back in sometimes. And that's always a possibility. Doesn't mean we have to. It's not 100%, but it's always a possibility. And that's why I always say the low point of that long lower shadow is a pretty decent support level if and when you ever get that second move back down to fill in the range. So bullish engulfing, on the SPY, of course, with the gap to the downside, and back up, in fact, engulfing multiple days in the last 4 candles here, not including the wicks, so just the bodies, engulfing the last 4 days there. And then, of course, the volume. So you look at the trading range on an average basis, way up above average. And remember how high that is. Relatively speaking, it's as high, I mentioned this before, it's as high as we had it back here. So because the higher, it's a higher number at above 5, but because the number itself up here is higher, then on a percentage basis, we are as volatile now as we were back here. But you notice with not nearly as much volume as we had back in early 2016, late 2015. So isn't that interesting? That wasn't too long ago. Yeah, we have this constant downward trend in volume on SPY, but the reality is on a long-term basis, that wasn't too long ago that we had that much volume. So again, it puts this move in perspective relative to other similar moves that we saw in the past that ended this ended a multiple-year long-term move. We got a lot of volatility, and all it did was start a new multiple-year, almost 2 years long-term move here off this early 2016 low, with that kind of dip there in 2016 coming off of Brexit,
Brexit here, and then the election here, and both of those just buying opportunities. Of course, the VIX still not below 20, so as bullish as today was, we haven't quite got below 20 yet. Break below 20, and we've got the beginnings, of a move back down potentially to 12.5, 15. Not below. I'm not looking for any moves back below 10, but definitely move back down to 15, 12.5 as we potentially move to a more, multiple month intermediate run here, and coming off a market sentiment low point. And again, just for some perspective, again, last times we got those market sentiment lows was, late 2016. We were coming off a 22.5. That was a market sentiment low point we had. And then these two here, and we're getting very similar patterns now that we got those, in late 2015, early 2016. And even this one here, we dipped down to 15, 12.5, 12, 13, 14 before that next move on 2016. That's definitely something that can happen again here, moving back here before it bounced back up into the mid to high 20s again, after another intermediate, after any multiple month intermediate rally that we're expecting. On a relative basis, you can see the VIX here is showing back down below 1. So 1 is a sweet spot for bearish moves. 1.05 or higher is extreme, and of course we got really extreme in early February. Not nearly so extreme this go around because we never did close above 110, which is like extreme. Like, that's 80 is extreme to the downside. 85 is a sweet spot. 80 is extreme, and of course getting below 75 is way extreme. It just doesn't happen very often. And you can see here we got down below it and back up above it, boom, in one day. But again, we didn't get nearly as extreme this time, which it goes to show that this second move, and I tweeted something out yesterday, this breadth improvement, this kind of shows that this second dip that we've seen has actually kind of been a bullish dip, because things haven't been nearly as extreme on this one as that first dip in early February, leading us to think, to assume, to expect, better buying opportunity off of this dip than we saw off that early February dip. All right, let's take a look at now what's driving this price action. Of course, the big word today is tariffs coming from the other side, of the coin now, with China issuing their list of potential targets, possible targets. But you can see again that just had a brief impact to the downside here with the gap. In fact, the stocks with the biggest gap to the downside, or the asset class with the biggest gaps to the downside, was emerging markets, right, with China in there, and then of course energy, commodity prices being the biggest target for some of these tariffs. Both those rallied. So off of the low points of the day for a lot of these asset classes, and the high point for gold and kind of almost a high point for long-term bonds, stocks are up 2.25%. And then you can see there's developed markets kind of trailing along there. Energy, crude oil up 2.25%. Then there's your long-term bonds and gold price, your safe haven asset classes. And you can see, remember we talked about how during that dip on Monday, how high yield didn't really drop very much. And you can see it's really kind of taken off. So really off of the low point on Monday, where we hit that low and came off of the low, it came and kind of closed into the highs pretty decently. And then including today's gap, you can see the biggest winners are U.S. stocks, up 3% off of Monday's low point. And then, of course, there's your international stocks, 1.5, half of that gain. You can see both large caps and small caps, pretty broad rally here. Emerging markets had a pretty good day yesterday too, but they gapped down on this tariff news, only to come back up and still finish half the gains as of off of that Monday's low point. But you can see gold down with the dollar up a little bit, gold down, and then there's your high yield up 0.5% off of that low. So doing pretty good, and energy was up, came down, and recovered all those losses to finish pretty much on par with where we finished Tuesday. So pretty broad rally, and puts the opening gap this morning in perspective, and compares it pretty much compares it to the opening gains, the gap to the upside that we had yesterday. You can see that bonds and gold gap down, And then bonds and gold gapped up today and finished down. So it was almost a little bit of a reverse yesterday in the open. But by the close, which is what matters the most, the open doesn't matter nearly as much. It has some, because of candlestick patterns, there is some effect, some impact of what the open looks like. But the open doesn't matter nearly as much as the close does, because the open usually ends up being the high of the day or the low of the day a lot of times, or at least right around the open in that first half hour of trading. The high or the low ends up being there. So the close is what matters. And so even though the opens were drastically different Tuesday to Wednesday, the closes were about the same. And so because of that, we now have a bullish posture on a lot of these, weak bullish, but a bullish posture on a lot of these major indexes. We take a look at the calendar, and of course the employment report. From our side of things, the employment report is what matters the most. And we still have pretty decent numbers. This is the histogram, is the ADP number, up 241. The one we'll get on from the BLS on Friday, that's that blue one that's doing really well. Manufacturing is not really gaining a whole lot, but not falling either. Still holding up very high levels there. And so just a reminder, from an economic perspective, the U.S. is still doing very well compared to everybody else in the G10. So, that bodes well for our stock market. As crazy volatile as things have been lately, that bodes pretty well. And you can see, you can see the first quarter shaded here. We've done pretty well. 2017, we had pretty decent economic indicators. We're kind of at where we were here, even though we got to a higher point. There's some of the other peaks that we've gotten around the beginning of the year, if not right at it. Other than 2016 when we had that double dip below the 200-day moving average. Every other year, we've got peaks around this time of year. So we'll see if that trend continues. The odds for a rate hike in June, which again reflect confidence in the economy from the Fed, is still pretty high for that. And of course, the GDP estimates for that first quarter have jumped, even at their lowest point, it's still a high figure, relatively speaking, for the quarter, and has jumped up. And we'll get another update to that here tomorrow when we get the trade numbers coming out. And of course, the big one on Friday will be the employment data that comes out. And you can see the Fed chair is expected to speak on Friday as well. If we were to take a look at what's driving the action off of Monday's low till now, you can see energy, of course, was doing very well. Energy stocks yesterday was doing very well. They dipped down on the gap with crude oil, only to rally back up and still finish up there. But you can see one of the stocks that's been up just about every day by the end of the day is that consumer discretionary area. You can also see consumer staples really pushing us off this rally too. There's utilities and real estate. They're lagging. They're still up. They're lagging a little bit. Remember, they've had a really good run during the pullback from a sector rotation standpoint. Staples haven't had nearly the decent run that those two had, and now it's kind of bouncing up. So consumer stocks really kind of taken off here during this bounce back up. And that brings us to our trade idea of the day, and it happens to be in that consumer sector area, consumer discretionary sector, and that is Under Armour. You can see Under Armour had a really good day with a lot of volume, 3 green arrows, spike in volume, trying to get up above, trying to come off of these higher lows. Is this a higher low point? Can we move up to a new higher high with earnings coming up, earnings here in February? This number helping out. Can we continue to push through? That's the question mark. Well, if you're expecting a bullish move over the next few months, and we see that consumer discretionary is leading the way right now, and really UAA, from a relative strength standpoint, has been doing pretty well here lately. If you come look at the long-term view on this, give it a second to load up here and look at the weekly chart. You can see, it's been underperforming for so long, and now looking like the relative strength is gapping, getting up above, these multiple weeks here. And this is the relative strength line, mind you, getting above multiple weeks worth of gains, kind of eradicating that big dip we had on the earnings in October, at the end of October there. Now potentially getting above its 200-day moving average. There could be some opportunity for this to run up to that area where it might meet another area of resistance on a relative strength basis, which means not only would UAA go up, but it would go up more, of course, in the market, and that would put us up into like this area here, 20 to 22.50. And of course, if you take a look, you can see another factor that's going on with UAA too is it's breaking above its Bollinger Band. And if I were to come out, let's look at multiple time frames here and look at the there's one standard deviation, right? One standard deviation move. This is by June. You can kind of see that it gets us up to this area. And if you take a look at the Theo price and look at buying a July option, 100 days out, so past that June 15th mark, which is June expiration, you can see that if I were to buy at the money option right now, and we did get up to by June 15th, you can see through June 15th would be the 16th. If it made a run to that 22.65, you can see easily getting, doubling, more than doubling the return. And again, if I'm going to put my stop order at half of 210, then I need to get it needs to get up to at least 420 for me to make it worth it, to get a 2-to-1 profit to loss. And you can see it does more than that. So we've got an opportunity here. Now, it doesn't have to do it tomorrow. And you can see if I were to draw my line here, give me 1 second. There we go. If I were to draw my line, there's my line to get from right now to that 22.65 level. Then there's my pace. That's the pace that has to continue to rally, getting up through this $18 level, getting up through that with the 3 green arrows and the spike in volume that we've seen, that we would expect that. And of course, if we don't, if it languishes, if it doesn't do that and it languishes by about here right before May expiration, if it languishes here and it hasn't stopped me out, then we'll just take whatever loss, whatever small gain we might have or whatever loss we have and get out of the trade and move on to something else, because it's got to move. For this to work, it's got to move at that pace or better for me to get a decent reward for the risk I'm willing to take on this particular trade. So again, that wraps us up for today. Thanks again for watching. Brandon will be back on tomorrow. Unless he's still feeling a little bit under the weather, I might still step in and help out again. But he'll be back on tomorrow, his normal scheduled day. And then I'll be back to finish the week on Friday. As always, we appreciate the time you spend watching these videos. Remember to like, subscribe, like, and comment. That way it doesn't throw me off there. Subscribe, like, and comment down below on the YouTube channel there. Do all 3 of those things. Hey, remember, if you're watching this embedded on the Market Scholars blog, you can do all that there too. Subscribe to our site, like the post there, as well as comment down at the bottom of the blog post. Remember, you can also, there's a link above the video to go discuss with others. Other market scholars there. You can discuss tonight's video and things we talk about here. So have a great evening, everybody. I hope you all have a great one. We'll see you all tomorrow.